Hi, and welcome to Crypto for Advisors, a podcast by Synergist. More than a third of Australians are into crypto, yet nearly 90% of advisors will not discuss it with them. I believe this is exposing investors to unnecessary risks, compromising the value of advised relationships, and limiting investment performance. My goal is to educate advisors and investors to bridge this crypto service gap while strengthening advised relationships. So let's get into today's episode. Welcome to another episode of Crypto for Advisors. Today I'm joined by Gabriel Carey from Cadre Capital. Gabriel has been at the forefront of making digital asset investments accessible to retail investors here in Australia, a space that's still evolving quickly. And I'm really keen to learn from Gabriel how he's approached this challenge and to share some of the strategies with you so that you might be able to take inspiration and apply them into your own work. So Gabriel, thank you so much for joining me. And maybe if you could start by just sharing, what drew you into digital assets in the first place?
Sure. Thanks, Andrew. So I think where there's some of our past history, so perhaps a little history as to where I've come from and then why alternatives and indeed digital assets have been of interest to me. So I first started in funds management in an alternative space in agribusiness. So it was non-tax driven agribusiness back in the days where there were companies handing out 10% commissions for people to jump into tax deductible. So going in that space was quite interesting, particularly when we were non-tax deductible and really chasing legitimate businesses. What that gave me an exposure to is the alternative asset class and how you can deliver outsized returns or even similar returns to what you can get from other assets, but in alternatives with a non-correlated aspect of alternatives that does enhance a portfolio. So I got very interested in efficient frontiers, risk-free return, and portfolio construction. Ultimately, I headed up Macquarie's funds management group, and there we were looking after a number of alternative managers. And again, it was very much around asymmetric risk. How can you get more upside than potential downside? But portfolio construction, how can you add an asset to a portfolio and improve returns and decrease risk? I think as advisors, we've all seen those graphs, but then it's more around, okay, that's great in theory. How do you practically apply that? I went through my career, moved into advice post GFC. And in that space, again, I was consistently looking at the alternatives. So building out your traditional portfolios, working with funds management. But then in 2017, a client actually asked me about Bitcoin. And I said, well, look, I haven't really been exposed to it, but I'll have a look. Always being interested in new and emerging asset classes. It wasn't an asset class at that stage, but I did get involved. So I ended up buying some Bitcoin. I always think the best way to learn is through personal application. So I bought some, went through the frustrating process of getting onto a platform, buying the asset, not really knowing what I was buying, which was actually a contract for difference. It wasn't really Bitcoin that I was buying, but the promoter didn't explain any of that to me. Subsequently, I looked for clients thinking, actually, this asset class is growing. And then in around 2020, I thought we'll do a deep dive into the space and look at the portfolio theory side. And when you start to look at it, and more recently I've looked at the results, it is phenomenal to think that over the last 14 years, 11 of those 14 years, Bitcoin has been the best performing asset and by a significant margin. So I then thought, well, actually, we need to get involved in this space. The biggest issue with digital assets, I think, as a financial advisor or a wealth manager is the business risk. So what we're concerned about is not only providing access to assets, but also what if that asset fails? Because that could then blow up in your face and you might only have a small exposure, but if a client loses all their money, then that can be very detrimental to the business. So I then looked at how we could get exposure to it without putting the client's capital at risk. Had a mutual friend of Merkle-Tree. So there's Dean Cerrone, Ryan McMillan at the time were founding a company, and they had been involved personally in founding a node, which is the operational aspect of digital assets. And Ryan was from traditional finance. Got together, got talking, and ultimately formed Cadre Capital, which was about providing retail investors exposure to digital assets, but in a very safe way. So I then have been using that particular method to get my clients access to the space. Why? Because it's a diversified portfolio. So again, I looked at all the different theory behind it. I'm big on the theory, but application's key. I saw the diversification benefits, saw that if you look at the trajectory of digital assets relative to the internet, it's alarmingly similar. to the early 90s, where we're just a short way along the journey. But in fact, the adoption of digital assets is now outpacing the adoption of internet along that trajectory. So I thought, this is an interesting asset class. I don't want to be just in Bitcoin because Bitcoin may or may not be successful, but I'm a big believer that, we're following this adoption curve. The whole asset class will grow. So I need to get exposure to that entire asset class. I didn't want to be selecting the tokens myself. I knew Dean and Ryan were masters of the space. So I'd hand off the professional management to them. That means that we're getting exposure to digital assets, but in a way that is professionally managed. I also found the tax aspect very difficult if you go direct. Being a unitized trust, that solved the problem. And so now I was able to offer my clients an exposure to this emerging asset class in a, I'd say, safe way, because it was backed by Lloyd's of London. Guess what I really was worried about, go back to the FTX days. If I put clients into an investment, I want the volatility or the risk reward of the asset class. What I don't want is the risk of complete loss due to some cretin in the industry stealing your money. So that was a very important aspect as well. So I guess it was an emergence of asymmetry, alternatives being able to improve portfolio returns. Now within the alternatives, what is going to give me significantly more upside potential than downside? So digital assets naturally felt into that space because you can put a very small amount into a portfolio and that can meaningfully improve the returns. And then it was around, okay, how can I access the space without blowing up a client's portfolio? So that's how we ended up in, digital assets over a journey and how I'm applying it with clients' portfolios now.
Great. Oh, thanks for the background. Once you start getting outside of Bitcoin and looking at other tokens, you are starting to see a lot of volatility. Have you seen the volatility change over the last 12, 24 months as a result of some of maybe the diversification of the investors into digital assets, for example?
The problem that I wanted to solve was, how do I get exposure to the asset class, being digital assets, not just Bitcoin, in a safe way, but I guess taking the right amount of risk. So when I looked at the industry, you could start with Bitcoin and you can hold it direct. And if people are looking at that, I don't see a problem with it, but probably hold it in cold storage. So you need to have a wallet. You hold that off chain. That means you're not going to lose your Bitcoin, but you might lose your key. So that's probably the other problem. You then move down to some of these, I guess, larger cap coins. So the likes of Ethereum, Solana, the layer ones. Now, how can you get exposure to that? That's the exposure I've got. So I'll come back to that. The next layer down, you start to move out on the risk curve into some of these meme coins. And I think you're taking a lot of risk there. To me, you're getting enough return in the larger cap, say top 50 by market cap in terms of the altcoins. You're getting sufficient return without taking too much risk. You then move down to token issuance and some of these platform providers. So there's all managers that are working all these different layers. And so I looked at another manager that was providing startup capital and also some of the mining. To me, that is, you might get outsized returns from one or two coins, but there's a lot of coins that can fall over. So when you talk about that volatility, that is absolutely happening in this meme coin space and certainly in the startup space. So I didn't want to go into that area either.
Yep.
So what I really wanted to do was get exposure to things that are proven technologies. And by that, I mean, the thing that I think is fascinating in digital assets is you can get on-chain metrics. So in BHP or any other listed share, you're waiting for the quarterly report. You then digest the quarterly report. You do some NPV if you're a fundamentalist, or you look at a research to see how the company's tracking against expectations, and then you either buy or sell because you think it's undervalued or overvalued. It's the same sort of approach with tokens when you're looking at the tokenomics in terms of, is there a real use case? Is there a real use case? And is the adoption growing? Now, what I think is really interesting when it comes to digital assets is you're getting that feedback live. So instead of waiting for a quarterly report, you're getting live feedback. So if we go back to these alts, what you're looking for is alternative coins that are increasing in the adoption and the amount of transactions going through them are increasing. And so they're getting paid more. And so the volatility in those sorts of real coins is not as high as what you're seeing in the meme coins. How does that translate into portfolios? What I've seen in portfolios so far is I guess we look at the Bitcoin dominance, which is if there's more people buying Bitcoin, the price of Bitcoin goes up relative to the price of altcoins. What we're seeing now is this Bitcoin dominance coming off, which means the Bitcoin price is still going up, but the price of the altcoins is going up more rapidly. So we may be experiencing a bit more volatility, but it's good volatility because the price of those alternatives are going up. Now, I think the trick is to know when to get off the train and go back into Bitcoin, or and that's where I leave the portfolio management to a professional.
Yep.
But at the moment, riding that wave has been good for clients. They've seen some pretty spectacular returns. I don't know if that answers your question on alts and how to manage it, but I think having a professional help is really important.
Yeah, what it highlights to me is that there's three types of participants. There's investors, there's traders, and there's speculators, shall we say, or gamblers. And crypto, has a bit of a reputational problem because of the meme coin segment, because it attracts more that speculator or gambler mentality where people are putting, they're looking for the 100x, 1000x growth opportunities, and they know they're taking crazy risks associated with that. But that's a very, very different dynamic to the traders who are looking for intraday technical analysis triggers to, trigger their buy and sell behavior, and they're managing it very, very actively on an intraday basis. And then that's different again to the investors, which is what most advised clients, if not all advised clients, should fall into that category, the investor bucket, where you're looking for more mid to longer term time horizons and you're looking for value. When people talk about meme coins, for example, or some of the longer tail of highly speculative plays, unproven tokens, a low market cap, then really that's not what investors should be looking at to put into their portfolio. Especially given that crypto is typically the more speculative component of their portfolio, they'd probably want to be sitting, like you say, in that top 50 token bracket, or the more conservative ones for the asset class. They still get the diversification that crypto brings. With the right allocation, it can improve their performance and reduce their risk. It's easy for people to get caught up in some of these, meme coin narratives and lose sight or discount the potential value of the layer one or the more established tokens and what role they can play in a portfolio.
I think you make a very good point there, but I don't see it any different to shares. So if you think about shares, you've got the speculators that are in there on hot copper or whatever is the flavor of the month, trying to make outsized returns, gambling. And that's how I see it. You then get the traders that are looking at technical analysis. They might be able to read the tea leaves or not. And then you get the fundamentalists or the investors, and we're stewards of wealth. That's our role, is to look at investments that we're holding for the long term, build out a portfolio that should generate good returns to investors without taking too much risk. The digital asset space is exactly the same. It's just, and this is where I think the challenge of the industry in terms of digital assets is, it's making people aware that it's actually no different. It's just another way. To me, digital assets, it's still built on a capitalist system. So you think about these tokens, why do they exist? It's a really, really clever way to start up a business. Why? Because you get, on Solana as an example, you get almost a cult of people that are behind the token, that are starting up an app that will help build the application. So then a good example might be Render or one of these applications where someone has an idea, or Helium's probably a good one. So they've got the G platform. They're saying, I've got some extra bandwidth. I'll rent it to you. Someone over here wants to use the bandwidth, so I'll buy it for you. So they start a token, and then they then say, if you go and jump on the Solana platform and buy the Helium token, you can make cash from renting out the space, or you can buy the space. It's no different to a normal business. What it does do, though, is it breaks down the global barriers. Mm-hmm. So you're suddenly being able to create a business on a global basis, and you just need that networkality. The same as Apple. You needed networkality that then causes some technology to improve, more users, more use cases, that the space grows. So not a meme coin where you've got someone's name behind it. that's pumping it up and saying, hey, this is, a good coin to buy because you're going to make $1 million. That's ridiculous. Don't go near it. Go near the technologies that have a genuine use case, and that adoption is growing.
And that's the industry maturing, isn't it? So what's your assessment on where the advised industry is at the moment as far as their understanding of this and their openness to digital assets? I mean, well, firstly, their awareness of, that these actual value use cases do exist, and it's not just all some speculative bubble or overhyped, meme coin. But then also their interest in actually learning about it and working out whether this asset class can benefit their clients. How mature do you think the Australian advised industry is today?
So I think it's not mature enough. I'll say that. And the reason I say it's not mature enough is because I'll give you 3 very simple examples. S&P 500 over the last 10 years, you can outperform that with lower risk by having 2% of Bitcoin and 98% fixed income. That to me is ridiculous. So you put 2% of Bitcoin into a portfolio over 10 years and 98% cash. So if you think about that, you can't lose money with the 98% because it's going to compound. You're going to outperform S&P 500 with lower volatility. If you put 2 to 5%, you increase your Sharpe ratio and you significantly increase the returns and decrease the risk with 2 to 5%. The one that I find really interesting is Fidelity did a artificial intelligence model. So they said, let's look at modern portfolio, 60-40 portfolio, equities, fixed income, international property. What allocation? So if we've got a 9% return and a volatility of 16, how much or how should the portfolio be allocated to optimize the risk or reduce your risk and maintain that 9% return? Pressed a button. The result was 7% digital assets. So that was a diversified portfolio of digital assets. And it said 7%, that will decrease the risk down to around 12. So you've now got the return of 9 with a volatility of 12. So you've reduced your volatility and maintained the same return. The next thing they said was, well, we've now got 16% risk. So the risk bucket's the same. Let's keep that the same. What return can we get for a volatility of 16? 10% digital assets. So suddenly it's moved. It's actually reduced the equity exposure and increased your digital assets exposure up to 10% of a portfolio. Now, I'm not suggesting that that's how much we put in yet because the industry is not ready, but somewhere between 2 to 5% I think is very reasonable. Why? Because all the data shows you that you will get a better performance with lower risk by allocating to digital assets. I think the thing that concerns people is loss. Again, if you look over, Bitcoin's a good example because it follows these halving cycles. If you go at the absolute top of the market, as long as you hold your assets for 4 years or more, historically, past is no predictor of future, but it tends to rhyme and people tend to make up history through fear and greed. You'll find that over 4 years, you always go to a higher level. So I think the way to reduce risk is to invest for the long term, put it into a portfolio with a fundamental purpose, and then allocate according to the outcome that you desire. So I think the industry needs to understand that fundamental theory, and it's not really promulgated that well. So we've had the 60-40, then we've had the COVID occurred and 60-40 portfolios blown up and it doesn't exist anymore. Then we go to gold. There's a whole bunch of different theories around, but we're not getting a lot of data unless you go and search for it on the digital asset space. So that's the first bit. I think the industry needs to understand that there is a very real use case to improve portfolio returns with lower risk by allocating to digital assets. The next issue you have, and this comes down to an individual advisor, is the business risk. So all I care about is getting better returns for my clients. I think it's really, the advisor should be looking for the same result for their clients. But some advisors probably say, no, too hard, because if I take that risk, I could lose clients because I'm talking about this digital asset space. I think that nervousness is decreasing. The industry is maturing, particularly with BlackRock coming out with the ETF. But we're still way behind other markets like the US. If you look at that now, on average, they're allocating 1 to 2% in a portfolio across the advised space. That is not the case in Australia. So it's much lower than that. Yet you look at the proportion of Australians that are holding digital assets, I think it really opens the eyes to the Australian landscape when it comes to investing. You've got 30 odd % of people holding digital assets.
Mhm.
Well, a very small proportion of financial advisors are out there providing advice in the space. And in fact, a lot of advisors, professional indemnity insurance cover will not cover them for that advice. So they've got a very real business risk. If something goes wrong, they don't have insurance cover. So these are some of the things that I think the industry are grappling with and need to get over.
And how does it get over that though? Because yes, there's a disconnect. If we look at the retail consumers, a third of Australian adults already invest in crypto. So the market has voted that this is a legitimate and desirable asset class. And then if you look at it compared to the US, the biggest economy in the world, and you say, yeah, look what's happened in the last 12 months in particular, and how much they've flipped completely. I mean, probably the last 2 years, it started with institutional banks all flipping 180 degrees and starting to understand digital assets and start advocating for it and providing access to their clients in it. Even JP Morgan now is an advocate of Bitcoin, reluctantly so. And then from a legislation point of view, the government flipping and getting behind it in the US as well, with the Genius Act, the Clarity Act under review right now, Strategic Bitcoin Reserve. So we're seeing all of this evolution, adoption, professionalization of this asset class domestically and globally. And yet, from an industry point of view, there's still no dialogue about it. There's no formal education about it. There's no professional sort of structured approach to embracing this, or at least trying to set some guardrails in place to accommodate this asset class. And as a result, asset consultants don't want to touch it or don't think they need to touch it, which means licensees are going to struggle to get it onto their approved list, which means there's no real demand yet for it. So from an insurance point of view, insurance aren't going to look at it because that's a scale game and they need a market to be able to insure. So how do we break this deadlock before we just fall so far behind that Australian customers just start either becoming self-directed and ignoring their advisors or going offshore?
So I think you've hit on a couple of points there. Asset consultants I'll come back to. How do we change it? It's a chicken and egg thing, I think, is the issue, Andrew. So go to research houses, asset consultants, and then PI insurers. They're all the same in terms of until you've got the demand, then they're going to struggle to go and do the research. But then I think we've already got the demand. And the reason I say we've already got the demand is, as you said, a third of adult Australians already hold digital assets. So we're ignoring the reality out there if we're not saying there is demand for this asset class. What's going to change will probably be the advisors requesting it. The way the industry typically works is platforms make it easier. So if you think about the different hurdles that we face as advisors, approved product list. Well, to get an approved product list, you typically need research. So we need the research houses, the likes of Lonsec and Zenith, Morningstar, providing research on particular digital assets and different digital asset managers. And they need to be out there championing space and providing that research. The problem is they won't do that research until they think they've got enough demand from advisors to justify them spending the time on doing the research. So I think it has to come from the advisor space. Then you've got the platforms. The hurdle for advisors in putting it into a portfolio now is being able to report on it through a platform. That is a lot of advisors, that's how they run their business, because it makes it easier from tax reporting, makes it easier for the clients to see what they're owning. Same problem again. If you go to the platform providers, a lot of them require the research, and they also require a number of advisors requesting the product to go on their platform.
Yep.
There's two issues. The third issue is your asset consultant. The industry seems to have shifted a lot towards these asset consultants now. So rather than me having the business risk, I've got an investment committee. So we do all that in-house, and we've got paid professionals that have a long history of experience that we rely on to capture the investment market's narrative, digest that on a monthly basis, and then provide portfolios that we believe will generate good returns for clients.
Yep.
Most financial advice businesses don't have that. They'll rely on an asset consultant to come in and streamline their product list, because that then defrays the business risk that they have.
Yep.
So if they were to go and put on digital assets on their portfolio, they're taking a personal risk, because the asset consultant's not going to suggest they use it because they're not there yet. So, Andrew, I don't know the correct answer. Aside from research houses, just one of them being, I guess, forward thinking enough to start doing the research, maybe the portfolio construction forum saying, let's get one of these managers in, or let's understand the portfolio theory behind it, because all the portfolio theory shows you it is absolutely an asset that you should be including into a client's portfolio. I hope that over time, people's eyes get exposed to those different portfolio research reports, but I don't know when the industry is going to shift. I really don't know the right answer. What do? Well, I take the time to research it, and I think it's contingent on every advisor thinking about their client and thinking what's in the best interest of the client, and then just taking the time to research it themselves.
Yeah, that's great. Look, there will come a time when we get a regulatory change in Australia, and that will be, the catalyst for the industry to adopt the asset, because that will de-risk it a lot for the larger players, if there's more regulatory clarity. So I think we'll see adoption really pick up when that happens. But when that happens is an open question that's been open for many years and remains so. But until that happens, let's say that's a year or 2 years before we get that, hypothetically, what advice would you give to other advisors on what they should be doing now, today, to to prepare themselves or to benefit their clients?
Education. Don't believe anything I'm saying. Go and do the research yourself. Don't believe anything you're saying, Andrew. Do the research yourself. And I think the first thing is make a conscious decision in your business. Am I going to utilize digital assets or not? Rather than just saying, oh, I'll get to it when I choose to. They need to make a conscious decision. Now, I guess I'm drinking my own Kool-Aid because I really, truly believe in the space. I think if advisors say, I'm not going to use it, you're doing your client base an injustice. And the reason for that is, again, it's the asymmetry of the space. It's the emergence of the space. It's like saying, well, I'm not going to use the internet in 2000s. What we'll do is we'll just wait till the internet takes over. And maybe when there's a use case for it, I'll go and educate myself on the internet. Well, you can't run a business without the internet now. I think if people look at the space and realize Visa, MasterCard are using digital assets for payment settlements. You've got global institutions that are settling using digital assets. These are not small organizations. It is not a very small industry. It's a $4 trillion industry that's growing at a very, very rapid pace. So if you do not keep up with what's happening in the space and you do not do your own research, then you're doing your clients an injustice. Take the time to research it and make a conscious decision.
Paul Atkins, the new SEC chair, has come in and said that one of his priorities is to tokenize the exchanges. I mean, it doesn't get any bigger than that.
That's
the biggest exchanges in the world, and he's saying, I'm going to take it on chain. We're going to migrate this to distributed ledger blockchain technology. For people to still be sitting there thinking this is some speculative made up token picture of a dog, and I'm not going to touch it, you're really doing yourself and your practice and your clients a disservice by not staying across what actually is changing and looking at the value that's been created by the technology first and foremost, and then let that then educate you enough to be able to look at it through an investment lens. Yeah, so education, and I agree completely.
Yeah, I think the issue is I guess it's the opinion of some people versus reality, which is you're kind of alluding to. Some people think it's a cowboy industry where you've got the dark internet or dark web, you've got crime, cybercrime, and a whole bunch of different things that's happening in the space. Well, look at stablecoins. I think the reason that the US is rapidly emerging in terms of the advised space and usage of digital assets is because they can see the problems that it solves. And I think one of the other interesting things I heard a few years back was it's a solution chasing a problem. Well, it's gone well beyond that now because it's solving real problems. Stablecoins, the third biggest buyer of US treasuries globally. and increasing. That's phenomenal.
It
And if you
is.
think what that means is the unbanked can transact with each other. There's a whole bunch of just very neat solutions that just go, okay, that kind of makes sense. Well, now that's a very elegant solution. It just makes sense. And as we evolve digitally and we want to be more anonymous as well, well, I think a digital token solves a lot of problems in that regard as well. Cybersecurity, digital tokens solve those sorts of problems. There's a whole bunch of problems that continue to emerge as technology improves. That means that this digital asset space has to be emerging and growing.
Yeah, no doubt. And if you overlay AI, the other major trend in this as well, we are moving into the agentic era of AI, where we'll be making creating our own AI agents to act autonomously on our behalf. Well, how do you think that they're going to interact? They're going to interact using stable coins, or other, cryptocurrencies, because you can put smart contracts in place around that. You can provide programmatic guardrails, which is really, valuable when an AI agent is autonomously interacting with another AI agent on your behalf. And they're going to be leveraging blockchain technology, distributed ledger, because it's going to be immutable, transparent, programmable. So all of these benefits. So this technology is already being adapted. There's more money being transacted in stable coins today than the combined Visa and MasterCard network already. And it's going to be supercharged as AI continues to take over.
Yeah, I couldn't agree more. It's that verifiability, if that's the right word.
Trustless.
Yeah, trustless. Like there is no other way that you can do transactions and track those transactions with 100% certainty. That is better than digital technology. There is no other way.
Yeah, that's right. And look, it's the other key element, which is probably a bit more controversial, but if you look at society and the fragmentation of society as well, you look at the blue versus red in the States, and you can see it across all Western democracies now, that you're really getting this rise of populism and this division, and the actual the policies being lost to in the noise of trying to win at all costs. And so that's really a breaking down of trust. That, if you look at all the surveys in America in particular, but they don't trust each other. They don't trust the other parties. They don't trust their government. They don't trust their institutions. They don't trust other governments, other countries. This breakdown in trust, that's going to affect currency, fiat currencies, and the relationships with the currencies. And eventually there's going to be this move towards trustless systems where you don't need trust. And that's what that's the core tenet of cryptocurrency. So you've got to think that as society evolves down this pathway, that there's going to be even more demand coming.
I think the other aspect to that is inflation. So a lot of the policies that are coming out at the moment are very inflationary. And the best way to eradicate the problem of inflation is through deflation of your currency. And that's another key issue. I think if you're holding coins in Bitcoin as an example, is Bitcoin really increasing in price, or is fiat currency deflating so quickly that Bitcoin's just holding its price? Now, I do think Bitcoin's holding its price because of their supply-demand characteristics. But that problem of inflation and problem of maintaining the buying power of your money also, I think, comes into the equation.
Yeah, we're in a scenario now where if you're holding it in term deposits or cash or bonds, even, you're going backwards. And
Absolutely.
And so that changes the fundamentals. Like you said, the 60-40 sort of approach is kind of like no longer relevant in this sort of inflationary environment where the dollar's getting debased. So yeah. Well, look, I've probably taken up enough of your time, Gabriel, but that's been fascinating. Thank you for sharing all of that, and well done for being such a pioneer in this space and sticking with it through and overcoming all those obstacles to the benefit of your clients. And I look forward to following Cadre Capital and watching how you grow. How can our viewers learn more about Cadre Capital and maybe follow you? What's the best way to stay in touch?
I'll probably just look us up on the internet. You'll see our details there, but Cadre Capital Partners, and give us a call. if there's something we can do to help you out, we're a full service business. And I guess this is a small part of what we do, but we're a big believer that you need to be looking at the right assets, having an allocation to get really good risk-adjusted returns. So decreasing portfolio risk and increasing return. But I also have to say, Andrew, a big thank you to you, not for just getting me on, but pioneering the education in the space. Strongly believe it's something that every advisor should be looking at and helping their clients understand the space. So big thanks to you as well.
Oh, thanks, mate. I appreciate it. All right. Well, thanks, Gabriel. Really, that was a great conversation. I learnt a lot, and I'm sure our guests did too. So I look forward to chatting again with you in the future.
Cheers, Andrew.
All right. Bye for now.
This podcast is for informational purposes only and does not constitute financial advice. All views of Andrew McPhee and his guests are their opinions only and do not reflect the opinions of Synergist. You should not treat any opinions expressed as a specific inducement to make a particular investment or follow a particular strategy.